Good morning, students. All the semester 4 students are welcome by the Department of Commerce, TDB College, for their first online live broadcasted class, which is arranged by our college for the students of semester 2, semester 4, semester 3 during this lockdown period. All students are invited to participate in the online class. Today, the first online class of semester 4 is going on. Today we discuss two topics of the paper Management Accounting. First unit is Introduction and second unit is Financial Statement Analysis. Topic list of Unit 1 as per our syllabus is Definition of Management Accounting, Objectives of Management Accounting, Scope of Management Accounting, Advantages of Management Accounting, Limitations of Management Accounting, Functions of Management Accounting, Differences between Management Accounting and Financial Accounting, and the last topic, Differences between Management Accounting and Cost Accounting. Now we discuss the definition of Management Accounting. According to CIMA, London, Management Accounting is an integral part of management concerned with identifying, presenting, and interpreting information used for formulating strategy, planning and controlling activities, decision making, optimizing the use of resources, disclosure to shareholders and other external to the entity, disclosure to employees, and safeguarding assets. Now we discuss the objectives of management accounting. Objectives of management accounting are planning. Management accounting assists management in planning the activities of the business. The second objective is controlling. Management accounting is a useful device of managerial control. Third objectives of management accounting is decision making. The main objective of management accounting is to help in decision making. Next, under management accounting, the data is properly classified, analyzed, and interpreted to make the accounting information more relevant for decision-making purpose. The fifth objective, increasing efficiency. By setting norms or standards for the units or centers, the management accounting evaluates the performance and helps in improving the efficiency. Next, coordinating. Budgeting is one of the techniques that create link between the objectives of the organization as a whole with the objectives of all the departments. Next objective is increase profitability, which means management accounting ultimately helps in increasing the profitability of an organization. And the last objective, performance evaluation, setting goals, objectives and standards and planning the best and economical course of action and then measuring the performance on the basis of these help an organization to increase the effectiveness and thereby motivate the members of the organization. Our next topic is scope of management accounting. The scope of management accounting includes the areas of financial accounting, cost accounting, revaluation accounting, statistical methods, operation research, taxation, organization and methods, office services, law, internal audit, and internal reporting. Out of which financial accounting relates to the major functions of management accounting is the rearrangement or modification of data. Financial accounting provides the very basis for such a function. Hence, management accounting cannot obtain full control and coordination of operations without a well-designed financial accounting system. The next area is cost accounting. We know that planning, decision making, and control are the basic managerial functions. The cost accounting system provides necessary tools such as standard costing, budgetary control, inventory control, managerial costing, and differential costing for carrying out such functions efficiently. There are different areas like revaluation accounting, statistical method, operation research, and the next important area is taxation. Taxation includes computation of income tax as per tax laws and regulations, filing of returns, and making tax payments. In recent times, it also includes tax planning. Another important area is law. Most of management decisions have to be taken in a legal environment where the requirements of a number of statutory provisions or regulations are to be fulfilled. Some of the acts which have their influence on management decisions are the Companies Act, MRTP Act, FEMA Act, SEBI regulation, etc. Next, we discuss that our next topic, advantages of management accounting. Advantages of management accounting are first point is increase efficiency of the company. Companies opt for management accounting as it increases the efficiency of company in performing operations. It contributes in striving for better performance by evaluating and comparing. Management accounting makes it easier to achieve various results. This indirectly motivates the employees to strive for better performance. As a result, they receive rewards in the form of promotion. Thus, management accounting indirectly increases the efficiency of the company as a whole. The second point is increase the bar of profitability. Management accounting includes budgetary control and capital budgeting. The use of this method makes it easier for the company to cut short the extra expenditures for performing vital operations. This indirectly increases the bars of profit for the company as the company is able to reduce its pricing on the product. The third advantage is simplifies the decision making in financial statements. Managerial decisions and other activities of management requires a simplified report of the financial statement of the company. For this action, management accountant creates a detailed technical report with simpler interpretation. Hence, he represents the key facts of the financial statement. This enables the managing officers to take up appropriate decisions for the betterment of the company. Next advantage is enables the fluctuation of business monetary funds. Another advantage is cost transparency. Next, flexibility and freedom. Next, assist in goal competition or objectives. Next, future prediction from past results. Next, advanced techniques and features. And last, managerial costing. or marginal costing. The next topic, now we want to discuss limitations of management accounting. Limitation of management accounting are: first, evolutionary stage. Management accounting is comparatively a new discipline. Its rules, principles, and conventions are still in the developing stage. A lot of research needs to be done to increase its scope. This limits the usage of management accounting in making a perfect tool for planning and decision making. The second limitation is costly. The installation of this system of accounting involves huge cost. It involves huge investment and wide area of network of the management, which is not specifically possible for the small organization. Third disadvantages or limitation is based on historical data. As management accounting requires lot information and data which is retrieved from the books of financial accounts and cost accounts, which in turn based on historical data. The success of management accounting depends on the accuracy of the information, and the cost data is inaccurate and not reliable for the decision making purpose. Next disadvantage is opposition to change. Management accounting demands a break away from traditional accounting practices. Installation of new techniques demands a change of attitude and acceptance and support from employees. It calls for a rearrangement of the personnel and their activities, which is generally not liked by the pupils involved. Another disadvantage is wide coverage. The application of management accounting requires wide knowledge of various disciplines like economics, taxation, statistics, and management, and so on, and not only of cost accounting and management accounting. These all bring abstractness and subjectivity in the conclusion obtained through it. Another disadvantage is not a substitute of management. Management accounting cannot replace the management. Management accountant is only an advisor to the management and provides necessary data for decision making. The decisions regarding implementing his advice is to be taken by the management. There is always a temptation to take an easy course of arriving at decision by by intuition rather than going by the advice of the management accountant. And the last disadvantage is subjectivity. There is every possibility of personal bias and manipulation from the collection of data to the interpretation stage in management accounting. Thus, it loses objectivity and validity. The outcome can be influenced and affected by the quality of the management team. The next topic, now we want to discuss functions of management accounting. There are different functions of management accounting, which are forecasting and planning, organizing, coordinating, controlling performance, financial analysis and interpretation, communication, special studies, protection of business assets, and miscellaneous functions. Now we discuss some points regarding functions of management accounting. First, forecasting and planning. One of the important functions of management accounting is to provide necessary information and data for making short-term and long-term forecasts and planning the operation of the business. The second function is organizing. The management accountant helps the management in organizing the human and non-human resources of the business by analyzing different functions and assigning specific responsibilities. The third function is coordinating. The management accountant increases the efficiency of organization and maximizes its profits by providing different tools of coordination as budgeting, financial reporting, financial analysis, and interpretation. It helps the management by reconciling the cost and financial accounts, by preparing budgets and setting the standard cost, and in analyzing variances in cost to facilitate management by exception. Other functions are controlling performance, financial analysis, and interpretation. The management accounting analyzes the data and presents it before the management in non-technical manner along with his comments and suggestions so that the owners and the top personnel in the management may understand it and take decisions without any difficulty. Other functions are communication, special studies, protection of business assets, and miscellaneous functions. Miscellaneous function, besides the above functions, the management accountant supplies useful information to different functional authorities, provides necessary accounting information and advice for price determination and price decision, and helps to take strategic decision as seasonal or temporary suspension of production, make or buy decision, replacement decision, and expansion on or closure of particular division or department, etc. The next topic is differences between management accounting and financial accounting. The first point of difference is aim. The main aim of financial accounting is to provide information to outside parties, whereas the main aim of management accounting is meant for management to take informed business decisions. The second point of difference is regulatory requirements. In financial accounting, it is mandatory requirements for public organization by the government. But in case of management accounting, the regulatory requirement is at the discretion of the management. There is no mandatory requirement. Next, government principles. Financial accounting statements are prepared on the basis of generally accepted accounting principles, whereas there is no standard basis for preparing management accounting statements. Next, time horizon. In case of financial accounting, time horizon for financial accounting is fast, whereas time horizon for management accounting is focused on future. Reporting beneficiary. Financial accounting is prepared for outside or external parties, whereas reports prepared under management accounting are useful to internal parties like CEO, directors, promoters, higher level managers, etc. Next point of difference is output. Financial accounting reports consist of profit and loss statement, balance sheet, and cash flow statement. Whereas management accounting reports are the monthly, weekly, or yearly analysis of products, geographies, functions, etc. Our next topic is differences between management accounting and cost accounting. The first point of difference is objective. The objectives of cost accounting is cost ascertainment, allocation, distribution, analysis, and cost control. Whereas the objectives of management accounting is to provide information related to decision making to management. Another point of difference is scope. Cost accounting is concerned merely with assisting in management functions, and management accounting is concerned both with assisting management in its function as well as evaluating the performance of the management as an institution. Next difference is evaluation. Evaluation of cost accounting is based on the limitation of financial accounting, and evaluation of management accounting is based on the limitation of cost accounting. Next point of difference is approach. The approach of the cost accounting is much narrower than that of a management accountant as they are more focused on cost ascertainment and cost control. In case of management accounting, the approach is much broader than that of a cost accountant as they have no use certain economic and statistical data along with the costing data to enable the management to be more accurate and precise in its functions of planning, control, and decision making. The next point of difference is source of information. Source of information for cost accounting is data provided by financial accountant. In case of management accounting, source of information data is derived from cost accountants and financial accountants. Technique. Another point of difference is technique. Techniques used in cost accounting are variable costing, break-even analysis, standard costing, managerial costing, uniform costing, etc. Whereas management accounting, in addition to the tool and technique used in cost accounting, also make use of another techniques like cash flow, ratio analysis, etc., which are not within the scope of cost accounting. Actually, time is very short. Only 1 hour is allocated to the Department of Commerce in each day for the students of Commerce Department, which includes semester 2, semester 4, semester 6, and in each semester there are three sections: accounting honors, finance honors, taxation honors, and program students. So, due to shortage of time, we want to take more classes by reducing the time spent. Now we discuss the unit 2 of management accounting. The unit 2 of management accounting is financial statement analysis. The topic list of Unit 2 as per our syllabus of Kazi Nazrul University is definition of financial statement, objectives of financial statement, users of financial statement, different types of financial statement, limitation of financial statement, definition of financial statement analysis, which is popularly known as FSA, financial statement analysis. Next topic is step in financial statement analysis, objectives of financial statement analysis, types of financial statement analysis, methods of financial statement analysis. The methods of financial statement analysis includes three methods. First one is comparative statement, second one is common size statement, and the last is trend ratios. The students, these are the topic list for Unit 2. Now we discuss each topic. First, definition of financial accounting. Definition of financial statement. According to the American Institute of Certified Public Accountants, popularly known as AICPA, financial statements are prepared for the purpose of presenting a periodical review or report on the progress by the management and deal with the status of investment in the business and results achieved during the period under review. Thus, financial statements are the major means through which business firms present their financial position and operating results to the owners, management, and other interested parties. The next topic is objectives of financial statement. Objectives of financial statements can be narrated as to provide useful information to investors and creditors in taking rational decisions relating to investment and lending. The second objective, to provide users with information for predicting, comparing, and evaluating the earning capability of the business firm. Third objective is to supply necessary information to the owners for judging the ability of managerial personnel regarding effective utilization of the resources of the business enterprise in achieving the primary enterprise goal. Next objectives to show how a business firm obtains resources and what it uses them for. The fifth objective is to disclose required information which enables both the external and internal parties to compare the financial soundness of the enterprise with similar other firms. Another objective is to provide information regarding accounting policies, contingent liabilities, etc. of the business firm which have a bearing in predicting, comparing, and evaluating its earning capability. And the last objective is to report on those activities of the business enterprise which affect society. The next topic is users of financial statements. The users of financial statements can be categorized into broad areas, direct users and indirect users. Direct user includes owners, management, creditors, taxing authorities, trade unions, and customers. Whereas indirect users include stock exchange, financial analysts, trade associations, competitors, financial press, other government departments, and general public. Out of direct users, the first one is owners. The owners invest funds in the business with a view to earning profits. Through the financial statements, they get required information for assessing the financial performance of the business. The second direct user is management. Financial statements provide necessary economic facts and figures through which the management is able to take their day-to-day decisions. Next, direct user is creditor. They are provide they are providers of short-term funds to the business and show they intend to know the short-term debt-paying capacity of the business firm. Financial statements are the prima facie evidence of the ability of the firm to pay off its temporary debt. Another direct user is taxation authority or taxing authority. Taxable income from business is calculated after making necessary adjustments as per certain rules and regulations under the Income Tax Act to the income disclosed in the financial statement. Financial statements may also be used for the purpose of indirect taxes. For example, sales tax authority may verify the sales tax liability with reference to the sales figure disclosed in the financial statement. Another direct user is trade unions and customers. Now we discuss the indirect users of financial statements. The first one is stock exchange. Every listed company submits its financial statements to the stock exchange authority, wherein the stocks of the company are listed. Thus, the stock exchange may publish these financial statements for the prospective investors for making their next indirect user is financial analyst. By making analysis of financial statements, the financial analyst can guide potential investors in taking their investment decisions. Another indirect user is state associations. They are to safeguard the interest of their members. For this purpose, necessary demands may be placed by them to the appropriate government agency. In most cases, disclosed information in financial statements form the basis of their demand. Other indirect users are competitors. Competitors analyze financial statements of their rival in order to judge their relative position in terms of liquidity, profitability, market share, and cost structure analysis. Other indirect users are financial press, other government departments, and general public. The next topic we want to discuss different types of financial statements. Different types of financial statements refers to income statement, balance sheet, statement of retained earnings, fund flow statement, cash flow statement. Income statement is considered as a very useful financial statement. This statement matches revenues and costs incurred in the process of earning revenues and depicts the net profit or loss for a particular period. It is also known as profit and loss account. Balance sheet. It is a statement which shows the financial position of a business firm on a particular date. It represents the assets under the possession of the concern at a particular point of time and the claims of the owners and outsiders against those assets at the time. The next types of financial statement is statement of retained earnings. This statement is also known as profit and loss appropriation account. It shows the utilization of profit earned by a business enterprise. Dividend proposed on both equity shares capital and preference share capital, the amount transferred to various reserves, etc. are entered in this statement. The balance of the statement is shown in the balance sheet. Another financial statements are fund flow statement and cash flow statement. Now we discuss the limitations of financial statements. Major limitation of financial statements are financial statements are essentially interim reports, as these statements do not provide final report of the financial status of the business enterprise. The second limitation, financial statement disclose the effects of the transactions of the previous year. The financial statement furnish only the historical data. Third limitation is financial statements are usually prepared in an absolute manner, and the figures reported in the financial statement do not speak on their own. Thus, these statements fail to provide much information about the profitability, liquidity, stability, solvency, etc. of the business concern to the users of the statement. The fourth limitation is financial statements do not reflect the impact of many qualitative factors which have a bearing on financial results and conditions of the business concern, as these cannot be expressed in terms of money and thus are not recorded in books of accounts. Another limitation is while preparing financial statements, several accounting postulates, conventions, principles are taken into consideration. However, there is a lot of contradiction among them, and as a result, a number of diverse accounting solutions to each of a few important problems are available. Last limitation or disadvantages of financial statement is personal judgment plays a vital role in determining the figures for financial statement. The next topic is definition of financial statement analysis. According to Metcalf and Titor, financial statement analysis is a process of evaluating the relationship between component part of a financial statement to obtain a better understanding of a firm position and performance. Next topic is step in financial statement analysis. Different steps of financial statement analysis are determination of the purpose of evaluation. Second step, selecting of information relevant to the purpose of evaluation from the total information contained in the financial statement. Third step, classification or grouping of the information selected in step 2 in such a way as to focus on the significant relationship. Fourth step, making actual evaluation by using appropriate technique of financial statement analysis. Fifth step, drawing of inferences and conclusions. The next topic is objectives of financial statement analysis. The main objectives of financial statement analysis are to evaluate the financial health of the business enterprise internally for management and externally for a host of users such as creditors, bankers, investors, etc. The second objective, to judge the earning capability of the business concerned and its sustaining capability to pay dividend out of net earnings. Potential investors are primarily interested in this aspect. Third objective, to assess the long-term debt paying capacity of the business enterprise. Debenture holders, financial institutions granting long-term loans are concerned with this aspect. Fourth objective, to evaluate the efficiency and effectiveness of managerial policies in different dimensions. Every stakeholder is interested in this matter. Fifth objective, to measure the degree of financial risk associated with the business firm. Long-term finance suppliers are concerned with this area. And the last objective is to judge the firm's ability to meet short-term obligations. Short-term creditors are keenly interested in this aspect. Next topic is, sorry students, some disturbance is occurred. Sorry for this interruption. The next topic is types of financial statement analysis. The financial statement analysis can be categorized in two types. First one is on the basis of material used, and the second one is on the basis of modus operandi. On the basis of material used, financial statement analysis are of two types, external analysis and internal analysis. And according to modus operandi, the financial statement analysis are of two types, vertical analysis and horizontal analysis. Now we discuss each type of financial statement analysis. According to material use, financial statement analysis can be classified into two categories, external analysis and internal analysis. What is external analysis? This is made by outsiders who do not have access to the detailed accounting records of the business firm. The external pupils such as investors, creditors, governments, etc. depend almost entirely on published financial statements of the business enterprise. The second type is internal analysis. This is made by the internal pupil who have an easy access to the books of accounts and other information relating to the business firm. It is carried out on behalf of the management for the purpose of providing necessary information for decision making. And according to modus operandi of analysis, financial statement analysis can also be classified into two categories, vertical analysis and horizontal analysis. When the vertical analysis, what is vertical analysis? When the analysis of financial statements of a business enterprise is made for only one accounting period, it is called vertical analysis. In other words, financial statement analysis based on relationship among items disclosed in the financial statement of a single accounting period is known as vertical analysis. Horizontal analysis. Horizontal analysis. When the analysis of financial statements of a business enterprise is made for two or more accounting periods, it is called horizontal analysis. In other words, financial statement analysis is based on comparison or establishing relationships among items reported in the financial statements for a number of accounting periods is known as horizontal analysis. Our next topic is method of financial statement analysis. Method or devices generally used in analyzing financial statements are comparative statements, common size statements, trend ratios, and ratio analysis. There are some mathematical calculations related to each method of financial statement analysis. These mathematical calculations are given in your study materials in detail. Students are advised to follow the study material for understanding the mathematical calculation of comparative statement, common size statement, and trend ratios. And the mathematical calculation related to another methods or devices, which is ratio analysis, it is discussed in another unit. That means the in ratio analysis unit, the details of these methods are discussed. These units will be uploaded in your study material section shortly. Now we discuss methods generally used in analyzing financial statements. The first method is comparative statement. Comparative statements are those statements of financial position and operating performance of a business firm which are so prepared as to provide time perspective to the various elements of financial position and operating results contained therein. The comparative statements are designed to disclose absolute money value of each item separately for each of the period under consideration, increase or decrease in absolute data in terms of money values, increase or decrease in absolute data in terms of percentage, comparison and percentage of total. Comparative statements are of two types. Comparative income statement, that is comparative profit and loss account, and comparative balance. Illustration related to comparative income statement and comparative balance sheets are given in your study material. The next method or devices of financial statement analysis is common size statement. In common size statements, the item of basic financial statements are stated as percentage of a total item. These statements are also known as cent percent statements or component percentage statements. These statements help in analyzing the financial performance of the business firm over periods. Interpart comparison cannot be made through the comparative statements as there is no common base for comparison in these statements. But the same can be effectively made by preparing common size statements because a common base for comparison is used in these statements. The common size statements are also two types: common size income statement and common size balance. The illustrations are given in your study material. Please follow the study material and practice the illustrations for your exam. The third method is trend ratios. Computation of 10 ratios is one of the important methods used in making a comparative study of the financial statements for several periods. It is actually a statistical device applied in the financial statement analysis to identify the trends or direction of movement in the financial position and operating results of the business firm with the passage of time. Ten ratios or percentage is to be computed by applying the formula. The formula is given, which is nothing but the relationship between absolute value of a particular item disclosed in financial statement relating to a certain period other than the base period divided by absolute value of that item disclosed in financial statement relating to the base period. That means absolute value of the current period divided by absolute value of the base period into 100. Some illustrations are given in your study materials related to trend ratios. Thank you, students. To complete Unit 1 and Unit 2 of the paper management accounting, due to shortage of time, detailed discussion is not possible, just like face-to-face teaching method. During this lockdown period, you are facing various problems, one of which is the examination of semester 3. Yesterday, a notice has been published by the Controller Department of the KNU related to the third semester examination. This notice is uploaded in your WhatsApp group. Please follow the website of the Kazi Nazrul University for updating news of third semester examination. And since the lockdown period is continued, your semester 4 classes are started by the college authority as per direction of the Kazi Nazrul University. So you are requested to continue your study of fourth semester, and when the notice for semester 3 will be given by the Kazi Nazrul University, then semester 3 examinations will be organized. During this lockdown period, online classes are offered by our college authority for semester 2, semester 4, semester 6. One class routine related to online class is published where it is maintained that semester 6, semester 4, semester 2, all semester students can get the benefit of online class. From today, the online classes for semester 4 are started and it will be continued up to another 4 days. Then the classes of semester 6 will be started for 5 days. Next 5 days, online classes will be offered for semester 2 students, and then semester 4 classes will also be started. This type of rotation of classes will be continued for all the students of our department. Yesterday, one message was sent in your WhatsApp group related to online examinations, which will be organized by the Department of Commerce of our college, and which is not be recorded as internal assessment of Kazi Nazrul University. This online test is organized uh, is organized for the judgment of your performance during this lockdown period. So all the students of semester 4 are requested to join in the online examination, which will be start in 12th May. The date and time are shown in your WhatsApp group. Please follow the official WhatsApp group of BCom Semester 4 students. Thank you students for joining this online class, which is lively broadcasted by the college authority for the benefit of our students. Thank you again.